आपको सीधे लिए चलेंगे एक प्रेस वार्ता की ओर। मुख्य आर्थिक सलाहकार डॉक्टर अनंत वी नाग।
So, in terms of the different components of gross value added, yes, we know that in the fiscal second quarter, manufacturing has shown year-on-year decline. We'll come to that later. But most other sectors are maintaining their overall growth rates. It is to be expected that after the strong base effect that we saw in the first quarter, that there would be a moderation in growth rates as the economy stabilizes and converges towards its trend growth rate over the coming quarters. In terms of real GDP components, we have government consumption, private consumption, capital formation, and exports of goods and services. What is heartening is that the capital formation rate as a percentage of GDP was more or less similar in the second quarter as it was the case in the first quarter, 34.6% compared to 34.7% in the first fiscal quarter as well. Government consumption is lower, but we will see later that the capital expenditure is maintaining its very strong upward momentum this year compared to last year. Overall, at the end of the first two quarters of the current financial year, we just present you India's growth rate in real terms, 9.7% compared to many other countries, including developing countries. And India's growth trajectory stands tall and well above the growth rates that other countries are experiencing. And we should understand that these growth rates are happening in the context of tightening of global monetary conditions, as well as basically the commodity price shock that we all experienced in the first several months of the current calendar year after the Russia-Ukraine conflict broke out in February. So therefore, India's growth performance becomes all the more creditable in the light of the commodity price shock, including fertilizer prices, and in the light of the synchronized tightening of monetary conditions that is still ongoing in the developed and in parts of the developing world, including ours. If you look at the manufacturing activity, the expansion has continued because the squares have changed their colors, and by and large, most of them are in green, light green or strong green territory, which shows that the sectors have experienced growth over the pre-pandemic levels. Except in consumer non-durable goods sector, many other sectors, whether it is power consumption, natural gas production, cement production, or steel consumption, etc., the levels are well above the pre-pandemic levels. The same thing can be said with respect to the services sector activity, barring domestic passenger traffic, which is still about 5% below 2019 levels. Other indicators of service sector activity have expanded quite ably and quite robustly compared to the 2019 levels, as you can see in this. Private consumption growth rate has rebounded, which is good news because that shows that households are in general optimistic about their income prospects and employment prospects. Consumer confidence surveys from the RBI taken before the monetary policy meeting takes place are also showing that the current situation index and the future is improving, and the future expectations index is maintaining its stable levels. Auto sales during the festival period, September-October, in comparison to the previous two festive seasons, which were blighted by the pandemic perhaps, has definitely picked up. And as you can see, the green bars, whether it is with respect to two-wheelers or three-wheeler, commercial vehicles, passenger vehicles, in all and in total is well above the previous 2 years of festive season sale. The banking system is one of the strong points of India. If anything, the last decade in the second half especially was spent on repairing balance sheets in the banking system, both financial and non-financial, and in the corporate sector. Now, due to government measures such as recapitalization, merging of financial institutions, and better provisioning by banks themselves, and also economic recovery happening in the last several quarters, has led to the situation where non-performing asset ratio has come down in both private sector and public sector banks, and in the overall scheduled commercial banks as well on your left side. On the right side, you can see that this improved balance sheet on the part of the banking system has also been accompanied by a willingness to lend. Credit growth is all around. It is not just concentrated in one sector. Credit to MSMEs is particularly strong, and that is gratifying. Credit to the services sector is growing at more than nearly 2%, and the overall non-food credit growth is running at the rate of about 12% or so. So it is clearly a very strong momentum in credit growth, and the demand for credit coming from all sectors points to continued economic momentum and growth continuing. Real investment rate as a percentage of GDP, as I mentioned earlier, has maintained its first quarter level of about 34.6%, just about 10 basis points lower than the number recorded in the first quarter of 34.7. And the government has clearly been supporting gross fixed capital formation in the economy. If you look at the capital expenditure on the part of the government, and you might have noticed it in RBI's monthly State of the Economy chapter in November, they showed that the quality of government expenditure is quite good, with CapEx registering a very strong growth compared to last year. In the first 6 months of the year, they showed that government CapEx went up by 49% on the union government side. And this one shows you the actual numbers, and this is for 7 months. 2.5 lakh crores last financial year. Compared to that, we are doing at 4.1 lakh crores. So on track to meet the government's projected CapEx for this financial year. And in terms of private investment, capacity utilization rates are approaching levels at which the private sector normally contemplates capacity expansion. And you can see that on the right side, with the overall total corporate capex picking up from the first half of 2021, from 2 lakh crores to 2.4 to 3.1 lakh crores. And if this crores of capital expenditure in the course of the current financial year between the union government and the private sector, and then we have to add the state government's capex as well. So that clearly will have a positive impact on future potential growth in the economy as well. Urban employment indicators, we just got the data last week or early this week for urban India for unemployment rate has come down to 7.2% from 7.6% before for the quarter ending September 2022. And we also see that in terms of the net employee provident fund organization, net payroll additions, the levels in 22-23 are running well above the previous 3 years. And that is a good sign that the economy has begun to generate jobs, and that will support consumption spending as well going forward. And also in rural India, apart from the festive season sale, which I mentioned earlier, we can see also indirectly the stability that is coming through in the rural economy in the form of reduced demand, because after all, National Rural Employment Guarantee Program is a demand-driven program, and that is on a downswing as well. A survey done by TeamLease, which covers 865 small, medium, and large enterprises across 23 sectors in India, show that the intent to hire has been picking up very steadily, especially in metro and tier 1 cities. So compared to several other regions in the world, the intent to hire is very high in India. And this will have a positive bandwagon effect as the intention to hire in large enterprises and bigger towns and metros will naturally create its positive catalyzing effect in terms of hiring in further downstream industry. Just as it happens when manufacturing sector picks up, services sector activity also follow in general. And this is the kind of positive bandwagon effect that will come through. And that is what we see in the hiring intentions being very strong in India, which is a good sign for the future. FPI flows are slowly turning positive for the entire financial year. We are seeing strong inflows in November, and there are anecdotal evidence to show that investor interest in India is very strong. And FDI flows for the current financial year in the first 6 months is about $20.2 billion, quite similar to last year's $20.3 billion on a net basis, on track to achieve a number close to $40 billion for the whole financial year as far as the net FDI flows are concerned. Forex reserves have recently picked up quite a bit from a low of $530 billion to 547.3, and together with the reduction in the monthly import bill that has happened since its peak in June, July, the import cover ratio has picked up and is now coming close to about 10 months of import cover as well. As far as the price pressures are concerned, they are clearly abating in India. As you can see on the left side, the inflation peak in India happened in April, and the current inflation rate is well below the peak of 7.8, whereas in many other countries, the inflation is still ruling very high, excepting the case of Brazil, which hiked interest rates quite a bit last year. But in many other developed countries, the inflation peak hasn't really, we can't be very sure it has happened, because the most recent number happens to be a very high, the highest number as well. And you can compare that against the previous peak, which happened 3 or 4 decades earlier. And India's, as we wrote in our monthly economic report as well, the pass-through from wholesale prices to CPI probably has run its course, because of the sharp drop in the WPI inflation from about 16% down to about 7 to 8%. So overall, real GDP growth in 22-23 is on track to be at the range of between 6.8 to 7%, and IMF maintains 6.8, RBI maintains 7%. And I think the more important thing is, if you look at the festival sales, if you look at the bank credit growth, if you look at the purchasing managers indices, whether it is services or manufacturing or the composite outlook, the economy has maintained its momentum, especially, I reiterate, in the face of very strong global headwinds and uncertainties in terms of higher input costs and in terms of monetary tightening. And that's a very good sign. It augurs well for future growth as well. So, in an uncertain external environment, and despite exports not doing as well as they did last year, although they are maintaining their levels quite well, domestic demand will drive GDP growth, and that includes consumption demand and capital formation. Domestic inflation is expected to ease further on the back of softening global commodity prices and expectations of a good Rabi crop. Corporate earnings outlook to improve as price pressures moderate, and also as demand remains strong and improving supply chains as well. Strengthening credit growth, flow of financial resources to the commercial sector point to sustained momentum in activity, and banks need to raise more structural liquidity to fund credit demand, which also will boost interest income for households and depositors. Stable banking sector is a major source of resilience amidst formidable global winds. India's banking system and financial stability, in contrast to what prevailed, let's say, a decade ago, is a very important strength and source of buffer for India as we still navigate uncertain global environment. Tightening of financial conditions in the United States, because we have seen in the last couple of months, there was a small storm in the UK pension sector. And then now recently in the United States, a crypto exchange has filed for bankruptcy, and several others are following in its wake. As monetary policy tightening rolls on in the United States, and also maybe in Eurozone, then you have the possibility that financial conditions in the developed world turn more unfavorable and risk aversion returns, whereas they have been on hold in September and October. And to that extent, it would have an implication in terms of strong dollar, and global risk aversion will also have implications for capital flows into emerging economies such as ours. But that will also have a silver lining in the sense that it will continue to keep input prices and commodity prices on the weaker side. So that remains the most important near-term risk. But as far as the Indian economy is concerned, this data confirms that the economic recovery continues, and most components of economic growth are stabilizing at a moderate pace, and we are on track to deliver a 6.8 to 7% GDP growth for the current financial year, and we can look ahead as capacity utilization rate picks up and as capital formation maintains its buoyancy and tax revenue growth indicates the vigor of economic activity, etc., we can look ahead to India building on its growth recovery further in 23-24 as well. With that, I will end my prepared remarks and I am ready to answer your questions. Thank you very much.
First question from Ajay Mishra, Doordarshan. Ajay.
We can't hear you.
Unmute. NIC is requested to unmute Ajay Mishra. Unmute. I'm not able to. We are not just. I'm putting a.
Can you hear me now?
Yes. Yes.
Good evening, sir. Thank you very much for the opportunity. My question to you is that what is your action vis-a-vis crude oil prices and the prices of fertilizers, because these are two main drivers when it comes to inflation management at home. So going forward, what do you see? Where do you see these two factors panning out in the next 2 quarters or so, because it will have a bearing on the budget making process also, sir. Thank you very much, sir.
So crude oil prices, we don't have forecasting models, and as we know very well, crude oil prices are a function not only of macroeconomic growth. I think those who are not speaking, please mute your lines. So crude oil prices are a function of both global economics and geopolitics. That is why predicting them becomes that much more difficult. But if you go on the basis of the assumption, therefore we have to make simplifying assumptions, that if the global political environment does not deteriorate, and given the global economic slowdown that is anticipated in 2023, and we are seeing that in the recent decline in both West Texas crude and Brent crude prices. So if they maintain their current trend, then it will not be a headwind for India's growth.
तो आप देख रहे थे सीधी तस्वीरें जो तीसरी तिमाही के जो सकल घरेलू उत्पाद के जो आंकड़े थे वो मुख्य आर्थिक सलाहकार डॉक्टर अनंत वी नागेश्वरन रख रहे थे और आंकड़े ये बताते हैं कि जुलाई से सितंबर तक का जो क्वार्टर था, जो तिमाही थी, उसमें 6.3% का जीडीपी ग्रोथ देखा गया है, जो पिछले बार यानी पिछले वित्त वर्ष में जो इसी समय में जो जीडीपी ग्रोथ था उससे कम है। और इसके अलावा ये भी कहा जा रहा है, ये बताया जा रहा है कि जो तमाम सेक्टर्स हैं अलग अलग अर्थव्यवस्था के, वो बेहतरीन प्रदर्शन करते हुए दिख रहे हैं। और खास बात यह है कि वो जो कोविड से पहले की स्थिति थी वहां तक पहुंचते दिख रहे हैं, उस तरह का प्रदर्शन देखा जा रहा है। खास बात यह है कि जो कैपिटल एक्सपेंडिचर है उसका आंकड़ा 4.1 लाख करोड़ से आगे पहुंच गया है इस वित्त वर्ष में, जो एक बेहतरीन संकेत है। इसके अलावा जो जीडीपी का आंकड़ा इस तिमाही, जो जुलाई से सितंबर तक की जो तिमाही का आंकड़ा है वो 38.17 लाख करोड़ रुपए का रहा था, जो पिछले साल से अगर इसकी तुलना करें या पिछले वित्त वर्ष से इसकी तुलना करें तो ये 35.89 लाख करोड़ था और इस बार ये 38.17 लाख करोड़ है। तो कई बेहतरीन संकेत इन आंकड़ों में मिल रहे हैं।